was provided, the audit results that were provided by Yo and Yo regarding our June 30th, 2021 audit that was performed. So we have Michael Rolka with us tonight, and he is going to run through a presentation, get a little bit into the numbers, where all these things came from, and then address any questions anyone may have at the end. So Mr. Rolka, I am handing this off to you.
Thank you.
You're welcome.
Is this all right?
I think so.
Okay.
Oh, yeah.
So thanks for having me here. I always like to start off with what the purpose of an audit is, and the purpose is not to find every small piece of noncompliance or every immaterial fraud. The purpose is to audit the financial statements and determine whether they're materially correct. And so that's an important piece of information to consider, because something that happens through the course of an entire year cannot be discovered over the shorter course of an audit. It can't be a deep dive of every single line item. The auditor's responsibility is to express an opinion on the financial statements based on our audit and based on our risk assessment. And what management's responsibility is to prepare the financial statements in accordance with GAAP, and that includes the design, the implementation of, and maintenance of a system of internal controls that can both prevent or detect internal controls, fraud or errors, and fix them in a timely manner. And so based on that, we provided an unmodified opinion, and that's basically a passing grade, if you will. That's what you're looking for, and that's the bottom line of an audit, is what is the opinion on the financial statements, and it's that they're materially correct. So this page here that I'm covering right now sort of correlates to the beginning of the audit on page 2-1 is the audit opinion, it's the auditor's report. Starting on 2-1, I should say. The opinion is right at the bottom, and that'll be changing with next year's audit. The standards have modified the way this opinion works. However, there are a couple of things on the following page that I did want to draw attention to that we call emphasis of a matter paragraphs. And so these are not required paragraphs, but when certain things occur, we like to draw a specific attention to them. So the first one is the adoption of the new accounting standard, and so that's GASB Statement 84, which is a new standard on fiduciary activities, and that has been implemented. None of our opinions are changed because of these emphases. It's just to draw attention. The next one was corrections of errors, which were restatements on the prior year balances. Those are detailed more in the footnote 15. And then we're also drawing attention to the deficit fund balance in the motor pool fund. The next graph is a 5-year presentation of the revenues and expenses as well as the fund balance for your governmental funds. This would correspond to page 4-5, I want to say. One moment. Starting on page 4-7. It'll be the total column on the right-hand side of the financial statements for the revenues. The next page has the fund balances and the expenses. So what you can see here is that revenues and expenses were fairly consistent year over year with the exception of 2018, and that was when the pension debt bond was issued, and that payment was considered, an expense that year to pay down the pension plan. 2021 saw an increase in revenues, and that was primarily due to some of these COVID-related grants. And fund balance has been pretty stable. The other thing I'd like to point out for all of these graphs and charts that we're going to go through, if they have multi-year presentation, please recall we audited only beginning balances on 2021 as well as the ending balances. So much of these numbers are not audited by Yo and Yo. It's for presentation purposes only.
Okay, the start of and end, what are those dates specifically?
So we audited July 1, 2020 through June 30, 2021.
Okay.
So the main thing I'd like to point out here is just things have been pretty stable year over year, and with a little bit of extra funding from COVID-19 related grants, and then with the exception of that bond payment in 2018. Page 4 is really the breakdown of, and a quick snapshot and summary of what is reported on page 4.7 of the financial statements. And by and large, you can see property taxes makes up the bulk of the revenue for the city at about 65%. That's the operating levy, the rubbish, the library, and the debt. The next part, which is also likely not a surprise, is the state revenue sharing sources at 21%. This does include the Act 51 funding for your roads, your major and local street funds. And then the remaining pieces are fairly small, but I did want to draw attention to the federal grants. Even though it was only 3% of the total makeup of revenues this year, that is higher than in past years at the city. Next, I'm moving to governmental expenditures, which is on the following page if you're following along in the financial statements. The top section of 4.8, again, just a snapshot of what it looked like during 2021. Something you'll notice is that the largest portion of your expenses goes towards debt service. And that's because of the various debt that's outstanding, including the pension bonds, which there's some of those out there in different communities, but that's less common to see pension bonds. And typically, you don't see debt service as the largest portion of expenditures. General government includes things such as administration, finance and accounting, clerk, legal, and that makes up 9%. Public works is 22%, which is your roads, street lighting, garbage collection, that sort of work. And then public safety is 21%, and that is often seen as one of the largest areas for governmental expenses. So between general government, public safety, public works, those are usually your typical big three. But here at the city, we also have the debt service mixed in. And you can see that on 4.8 in the totals column where those numbers are coming from. Next slide on the governmental funds is the lower section of page 4-8, where it shows the total fund balances. But if we actually flip back to the page 4-5, this is where it breaks out the different sections of fund balances, which is on the balance sheet. You can see from 2017 through 2021, fund balance has risen overall in the governmental funds, with a current year increase of about $2.2 million, half of which is in the general fund. About 25% of that is in the sidewalk construction fund for unused bond proceeds from new debt. And the remainder is mostly restricted for roads. That's the bulk of what's going on in the 2021 column there. In your general fund, there's $4 million of unassigned fund balance and small amounts of non-spendable amounts. And what those represent are prepaid purchases. So it could be prepaid insurance, it could be inventories, those types of items. The remainder of about $3 million is restricted for your various levies that have to be held intact for those specific purposes, so such as road funding, libraries, capital projects, when there's debt-related items. Next, we move to the enterprise funds, and if we flip ahead in the statements to get towards those begin on page 410. I'd like to flip to the operating statement, which is 412, however. The red bar chart and the blue represent the operating revenues and operating expenses. And so typically what we'd like to see is for those to more or less mirror each other to make sure that you can tell that rates are in line. When you start to see a trend of expenses exceeding revenues, that could be a good indicator that the water and sewer rates, for example, may not be appropriate and may need a rate study done, or that maybe something isn't being charged out correctly. I'd like to point out the top line in that kind of gold color is the net investment in capital assets. And what that represents is your net book value of your capital assets less any related debt. And so a steady increase in that number is a good thing, and that's what you'd want to see because it shows reinvestment in your water and sewer systems, as an example. Then you can see that your net position in the gray line has been fairly consistent year over year, similar to how the revenues and expenses has been pretty consistent year over year. It dipped slightly this year due to the inclusion of the net OPEB liability. Next, I'd like to go over to some of the required communications with governments. That was provided in a separate letter. There's some boilerplate items, if you will, in that letter that I encourage you all to read, and I'm not going to cover every piece that is kind of the usual, if you will. It also goes over the planned timing and scope of the audit, and then a few other things that we always like to point out. So this year, GASB Statement 84, fiduciary activities, was adopted, and that was something I mentioned earlier. Yes,
Is that this one?
that is it, correct. GASB Statement 84 was a pretty big standard with significant changes, and one of the things that does is it pulls in your pension and your OPEB plans, the tax collection fund, and you're required to report all of that stuff in a uniform manner, as well as the additions and deductions to those. In the past, you've often seen just assets and liabilities for certain types of fiduciary funds. It also describes what the significant estimates are based on our evaluation of your accounting policies and financial statements. Those were the net pension liabilities, the net OPEB liabilities, and useful lives of capital assets. We evaluate those. We look for bias in the determination of them. We look for consistency with other municipalities, and we've determined they're appropriate. Lastly, one of the next things we like to point out is the upcoming standards that will affect future years, just to make sure that you as council and finance team is aware and knows what to expect and what to plan for and prepare for. There's two coming up that are fairly significant. GASB Statement 87 is regarding leases. And so what this standard will do is essentially bring all leases, whether it's termed lease in the agreement or not, onto your balance sheet. And so if you go out and you lease, let's just make something up, a new building, that will become an asset on your books and a liability on your books. Whereas under current accounting standards, there's a test where you check the economic life of the asset and you check whether there's bargain purchase option, various tests to run through. So that asset under the new standards may not, under the current standards, may not go on your books. It'd just be a footnote disclosure and you pay as you go. Similarly, GASB Statement 96 is very much the same for leases, except it's for subscription technology. So you'd think of the various softwares that you have to pay subscription fees to maintain and keep. Probably like your accounting software comes to mind. Lastly, there's other communications in this letter that I'm going over in the next couple slides. So during the course of an audit, we have to evaluate when we find errors or other adjustments, what level of an error do we consider it to be? And that depends on whether it's material to the financial statements. So we do have a material weakness for audit adjustments, and those adjustments have been attached at the end of the letter because we had several adjustments to the prior year and various adjustments throughout the year, during the year, to bring the balance to be materially correct. And had those adjustments not been made, that's when we would not be able to provide an unmodified opinion. All the adjustments have been made, therefore an unmodified opinion is appropriate. And those can be seen in appendices 4 and 5. The one is the comprehensive list of the adjustments, and the other one is just the list of the prior period adjustments.
So what do these three mean, like lack of segregation of duties?
Yep, getting into that one right now. So significant deficiencies are less severe than a material weakness, but still something that we believe council should be made aware of. And so lack of segregation of duties in this case was primarily due to two causes, and one being journal entry review. There's no secondary level of journal entry review, manual journal entries. So that would be an input into the general ledger that is manual, not running through another system, so the accounts payable module isn't feeding into the general ledger in this case. This is manual journal entries, which are always required to some extent. You're going to find errors from time to time and correct them. You have to make accruals at the end of the month or end of the year, depending what it is. But it's always good to have somebody do a secondary review of those, because more often than not, when a fraud does occur, it has to have some component of a manual journal entry. Secondly, bank reconciliations did not have a secondary review, and we suggest that bank reconciliations have a secondary review because one way or another, usually, again, if there's a fraud, it has to flow through the bank account. And so if there's another set of eyes on the bank account, that's a good thing.
Who in our group would do that, Kelly?
I'm currently doing it. I've already got, one of the treasurer's staff will be, reviewing going forward.
Next, there's an unrestricted deficit in the motor pool fund. That's a non-compliance issue, and a corrective action plan with the state will be required. Part of the reason that deficit was created was because of the inclusion of the net OPEB liability of about $180,000 this year. But even without that, it would have ended in deficit. And so I don't have a long history here at the city, but what that typically means is that not enough charges to other funds for the services that fund is providing have been done. So whether the rates need to be increased or charges may have been missed, I'm not sure. But based on that, that's typically what that may be caused by. Lastly, and this one is just something I'm obligated to call out as a non-compliance, is the untimely filing of an audit, which, again, I don't expect to be an issue in the future. I don't think we need to talk about that any further.
Can you go back?
Yeah, absolutely.
So,
sorry.
on the segregation of duties.
Yes.
So, is there and Kelly had mentioned that had to have someone from Treasury that would look at it. Is that a standard practice, or is that would itself, that process would be audited as whether it's appropriate or inappropriate?
Yeah, so what we really want to see is an independent secondary review, so that if there's just one person doing something, fraud can infiltrate the system very easily. The opportunity is there. So we want to have a second set of review so that two people have to collude if they want something to happen, right? So you have to have two dishonest people. Not saying you're dishonest, Kelly, please.
That's me.
Yes, this is just the way it is, right? So one person prepares it, somebody else reviews it. And it doesn't have to be Kelly prepares, treasurer reviews. It could be, a variety of people or positions, I should say. But that's the point, is a second independent review.
But that person needs to be defined so that it's consistent every time
that it happens? Or
That's
they can
that's
be
common.
arbitrary, that, okay, this time it's going to be somebody else to take a look at it, as long as
see.
it's documented that who it was and when it happened?
So typically what I see is one designated person for the review with perhaps a backup. I wouldn't say you'd gain any benefit by just spreading it all around, because it's probably better to have consistency so that somebody, when they look at it and they know there's this recurring monthly thing, maybe there's one certain bill that comes out of the bank automatically every month. So Kelly isn't getting the same question every single month, and somebody will build up and be like, okay, I know what this is. I see this every month. This is good. To have that knowledge. Yeah, that's what I see.
Okay, so we should establish that consistency. It sounds like that's what you're going to be doing. Again, from my experience and my background, once you have a process in place, that's something that should be audited and reviewed.
Yes.
That's happening every time.
Correct. Yep, that is correct. And that's something that we look at every time. We're required to look at it for our auditing procedures report that we have to submit to the state to determine whether bank reconciliations have been prepared timely and reviewed. So,
Okay.
yes.
All right, thank you.
Okay. Next, we have some items that we call management comments that we aren't required to disclose to council, and we aren't, that don't have to go to council, but we bring them up to management as suggestions. These are often best practices or ways to strengthen internal control for areas that we haven't identified as a significant deficiency or a material weakness, or areas of non-compliance that we don't view as material to the financial statements. In this case, we have 4 suggestions. The first one would be to implement a written capital asset policy. That policy should include, well, there's something in the financial statements already, but it's not supported by a policy in any way. It's just been a working policy based on what's in the statements. But the capital asset, excuse me, policy should have what your useful lives are, what your capitalization thresholds are, how many years do you have to expect it to be useful to be used. So commonly I'll see a minimum of $10,000 with at least 2 years of useful life, and the categories, infrastructure over 30 to 50 years, buildings over 30 years, whatever you guys determine is appropriate. But a written policy on that just helps to set everything in stone, and then future people know where to go to determine how long to capitalize something over. The next item is regarding compliance with the Michigan escheat laws. And what that is regarding unclaimed properties. So after checks have gone stale, dependent on the check type, ranging from 1 to 3 years, those checks need to be remitted to the state of Michigan. And so that hasn't been followed, and there hasn't been a policy in effect. So we would suggest creating a policy so that law is followed. I believe it has to be remitted annually in March. The city has credit cards. They use them and they accept them as payment. And a little bit of an older law, I believe, came out in 95 or perhaps 2001, requires that in order to use credit cards and accept credit cards, a policy must be approved by resolution of council. As far as we are aware, as far as Kelly was aware, we couldn't find those anywhere. So I suggest developing those policies, approving them by resolution so that you're in compliance with the state laws there. Lastly, there were some budget overages that are identified in footnote 2 that we could flip to quickly to relate it to this on page 425. When there are budget overages, we're required to submit that to the state of Michigan and then disclose it in a footnote. So in this case, all of the overages were in the general fund. Often when I see budget overages, it happens when there's audit adjustments because maybe an accrual wasn't thought of or what may have you. I know the budgets are adjusted here and reviewed, but given the level of audit adjustments, I think that's the primary cause of them in this particular year.
So when it comes to pointing out that we need a policy, you're not here to tell us which one to use, other than if we pick one when you come back, if you come back, that you'll determine what the appropriateness and whether or not it was followed.
Yep, in the letter I provided actually is a link to the actual law. In it,
Okay.
it says step by step the pieces that need to go into it. Often I see city attorneys draft these, and a lot of them have a boilerplate for it ready to go.
So I'm already working on the capital asset policy as well as the credit card usage policy. So hopefully in the next
I have
3
examples as well.
weeks- I've got it.
Okay.
Almost done.
All
In the
right.
next 3 weeks, we should have something to council
Okay.
to review.
Right, thank you.
So that concludes the presentation part, and I'm happy to now go through the statements in a little bit more detail unless you have some questions you'd like to go over first, as it relates to that.
Anyone?
I just have one quick question.
Sure.
Under the debt service, the budget variance, the appropriation is 374,000, the actual is 492, so the overage is 117, which is a significant percentage. I guess I'm wondering, debt service is kind of a set payment plan normally, so how was it? I mean, I understand the other items, there's gonna be small variations.
Yep.
But that one seems significant percentage-wise. I don't know, Kelly, either one of you have an answer for that?
I believe that one of the debt service payments was not budgeted. I know I submitted a budget amendment in June of last year that was not approved by council. I'm not sure if that was in there, but I know that one of those debt payments was never budgeted in one of the funds.
You just said not sure. Can you check it and send it to us?
Yes?
Okay.
Any other questions about the presentation we just saw? Okay, Michael, you may proceed to the other information.
Okay, so first, I'd like to briefly go over the letter attached, and we did go over all the key points in it, but I want to briefly point out where some of those are so that you can read them in more detail. Page 2 identifies those adopted accounting policies standards that the GASB put out. You guys are required to adopt those anytime they put them out. At the bottom of page 2 are the significant estimates. Following on page 3 is information that we provide as a benefit to our clients regarding cybersecurity posture. Basically, some best practices with cybersecurity that isn't a representation that you guys are failing any of these tests, just additional information for you. Page 4 identifies some of the uncorrected misstatements in the middle there related to the prior year that are correct now, but weren't corrected at the end of the prior year. If I just confused you. So because of the way they ran through the current year, it made more sense and was more efficient to leave them as they were. And it's correct at the end of the year rather than at the beginning of the year, as we audited the opening balances and the closing balances. Typically during an audit, we only look at the end of the year balances, so we didn't adjust the prior year for these balances. We just let it flow through the current year. So everything at June 30, 2021 is correct, even though these were not corrected in the prior period. Does that help explain a little better? Page 5 just identifies some of those emphasis of a matter paragraphs that we have in the auditor's report. Again, I'm skipping all of the standard verbiage in these letters and just pointing out the key pieces for you. And then Appendix 2 begins on page 6. This is where it goes into a little bit more detail about the findings, the audit adjustments being the material weakness, and then several significant deficiencies. Page 8 is the management comments, as we call them, so the capital asset policy, street laws, a couple of these credit card usage and acceptance policies with links for guidance on how to comply with these things. And then beginning on the following page is Appendix 4, which are all of the audit adjustments that we had throughout the year. There's a couple of pages of those. And is it the last page? Second to last page, is that right? Yes, is where the prior period adjustments are summarized. And so I want to go over these a little bit more because this was a big hang-up in the audit. It was being comfortable with those opening balances. And so in looking at the supporting documentation for essentially the June 30, 2020 balances, or in my case, July 1, 2020, we had to make all of these adjustments to the prior year in order to bring those balances to be materially correct. And so that in itself was a material weakness. It's not typical to find any prior year adjustments. So that's not something you'd expect to see or be a usual thing. Okay, any questions in there?
So when you do come across that?
Yes.
What are the circumstances that create that situation?
Sure, so it can be a number of things. Many times accruals may not have been posted correctly at a certain time period. One of the most common things is a capital asset wasn't properly capitalized. It was just an error. It's usually errors, but capital assets is a really common one. So maybe a fire truck was purchased and somehow wasn't capitalized. A really common one is inappropriate accounting for capital leases under the current standards, but those are some of the most common.
Okay. So could something have been followed under proper guidance or procedures previously, and then it changed as far as the policy, and then that wasn't caught up, and then now it is?
Yes, so as an example, GASB Statement 87 on the leases, the new one that's coming up for next year, that has the potential of restating the audit I just did. Mm-hmm. But when that happens and you're restating prior balances because of an adoption of a new standard, that is the appropriate way to do it, and you have to do it that way. So it's not considered a material weakness. It's still a restatement of your fund balance or net position, whatever it may affect. Mm-hmm. But that's the way that you'd have to approach it.
Okay, and in doing that, you would cite the new GASB standard?
Correct,
Okay.
Absolutely.
Okay, so that could have happened here, we just don't know.
Yeah,
And you're not here to guess.
Some of it could have been that certain standards weren't adopted correctly in certain periods. It could be. I don't know that yet.
And no way to find out now?
What's that?
No way to find out now?
Unless we want to go back, it wouldn't be worth your effort, time, money, all of that.
Okay, all right.
Okay. Now, in the actual financial statements themselves, I'm going to point out a few things and then go into some of the details. So we already discussed earlier that starting on page 2-1 is the auditor's report and the opinion. Whenever you're looking at that, the main thing you want to look at is that header called opinions to see whether we've issued an unmodified opinion. I have very, very rarely issued something other than an unmodified opinion. I have disclaimed, I have issued qualified opinions, but that's much less common, especially for governments. That hurts. Going to move along to the next section, which I will not go through, but I want to explain what it is. Section 3 is the management's discussion and analysis. And that section is really for management to give their take on what happened during the year, as well as provide some future outlook. And in that section, if you're not going to read through these financial statements page to page, this is the best place to go for a good summary of the year.
Is this written by us or by you guys?
This is written by management, so it would have been Kelly and Scott.
This is, you mean all of section 3, or?
Correct.
Okay.
Next, section 4 is the basic financial statements, which include the financial statements plus the related footnotes. Page 4-1 is the statement of net position. And what the statement of net position is the government-wide, essentially balance sheet, if you will. And that shows your full accrual level of accounting. So all of your long-term assets, long-term liabilities, everything's included in here. Conversely, we'll get to the fund level, which does not include your capital assets, pension and OPEB liabilities, debt, because it's focused on the current term. So some of the big things that you'll see on here are your capital assets, right? That's some of the most you spend your money on. And you'll see that the capital assets for the governmental activities is just over, well, it's $27 million there, and a little bit above it of $700,000 that's
I'm
not being
sorry,
depreciated.
If I can
Yes?
stop you there, which?
Sure.
What page are you on? I'm sorry.
4-1.
4-, okay.
Yep.
I got it in section 5, sorry.
Actually read these, I didn't get the electronic version.
Okay, almost there.
Sure, no problem. So all I was trying to get at with the, with this page is that it is very typical that capital assets will be your biggest asset on the books, often followed by cash and investments at a government, which is true here, as you can see. Also, there's the $6 million intangible drain asset in the business type activities column. And what that column represents is your water and sewer and the senior citizens fund combined. On the far right is the component unit. That's relatively minor, so I'm not gonna touch on that much. On the following page, it's the full accrual level of your liabilities. And so when I say that, I say full accrual, and the other term would be modified accrual. And so the fund level financial statements, so like your general fund, you'll never see a debt liability in your general fund because it's modified accrual. It's cash basis with some receivables and payables. It's just a little different. This is the full accrual where you can see the debt is, if you add the due within 1 year and due in more than 1 year, about $31 million. And so that's what's driving that big debt service proportion of annual expenditures that we discussed. That's by and large the biggest liabilities. You also have the total OPEB liability at $12.6 million. And a liability to MERS, which is relatively small in comparison. The last piece of this is the net position at the bottom. The net investment in capital assets represents your net book value of your capital assets less any of the related debt. We have to show some of the restrictions for varying outside restrictions. So that might be whether you have a tax millage that's voted or somebody made restricted grants to you. And lastly, unrestricted or deficit in the case of the governmental activities. This is very, very common for governments in the governmental activities to have a deficit unrestricted amount because of the pension and OPEB plans. So common, state doesn't want it reported. It just doesn't have to come up because it's so common.
So you're saying that represents pension liabilities?
Not
In large part?
entirely.
But in large part?
I'm sorry.
In large part?
Large part, yeah, yep. So the OPEB liability is 12 million, and well, I guess a large part of it is, but you also have to back out that net investment in capital assets. So that's required to be shown separately, and then it includes it. Maybe that's a better way to say.
Okay.
But that's often why you see a deficit there, whether it's your city or another one. It's very common.
So to kind of put it in layman's speech, the deficit position is a combination of pension liabilities and,
And the long-term debt.
okay, which is funding all sorts of various projects.
Yeah, all across the
Whether
board.
it's parks and roads. or
Parks,
whatever.
buildings, whatever you've bonded for over the past probably 30 years, truly.
Okay.
Yeah.
So, okay.
Okay. The next page, I'm not going to go through in too much detail, but because this is a schedule that frankly I've never enjoyed. It's it's supposed to be like an income statement for your full accrual level, but the layout as prescribed by the GASB is just not pretty, and it's hard to read. But what it tries to break down is what your full accrual expenses are by function there, so general government, public safety, and then it backs off directly related revenues, the program revenues, so that you get to that column you see all the negative numbers in. It's the 1, 2, 3, 4, fifth column over. So that's the net of directly related revenues compared to your total expenses. Then it drives down to add back the property taxes that can be kind of used across the board, or your unrestricted state revenue funding sources, and some other things. But this is ultimately like an income statement, just not as pretty and not as clean. And we'll get to the modified accrual statements, which is really what you're used to your numbers being reported on. So that begins page 4.4, which we did go over the totals already. You can see 4.4 totals the assets. Let's pick on general fund at 4.7 million, and then as you flip to the next page, that will agree to the bottom line of your liabilities and fund balances combined. So your assets less your liabilities is your fund balance, and your fund balance is fairly healthy, about $4 million of unassigned funds at the end of the year in the general fund. The other funds represent restricted funding sources, and so their fund balances have been restricted as appropriate. Page 4.6 is a page that takes the total fund balances of your governmental funds at the top, the $7 million, and this is where it shows you what items are being added or subtracted to bring you to your full accrual statement of net position. So this is where you'll see capital assets being added back in, the long-term debt being pulled out, pension liabilities or assets being adjusted for. That includes other items too, compensated absences, anything that is not a current asset or current liability for your fund statements.
Can you explain to them what's included in the government?
Yes, so governmental funds, so there's governmental funds and there is proprietary funds. I'd like to actually start with the proprietary funds. It's a little easier to understand. Proprietary funds are like businesses that are driven with charges for services. That's what determines if something is a proprietary fund, if it's primarily supported by charges for services. That's why water and sewer funds are always proprietary funds. You guys are selling water and sewer charges to the citizens. Governmental funds are, general fund is always governmental, and then special revenue type funds, debt service funds, capital improvement funds are governmental funds. And special revenue funds are something that has a restricted revenue source as its primary driver. So think of your major and local streets funds. Those are driven by primarily Act 51 fundings. Often you'll see a road millage or a trash millage. Those also would drive and create special revenue funds. So restricted funds that have to be set aside and restricted as to fund balance.
Enterprise, is that synonymous with proprietary fund?
Almost. So proprietary funds also include internal service funds. So it's, if you look at it as like a hierarchy, it's internal service funds, enterprise funds, and then over top of them is the proprietary funds. Just like, so for governmental funds, at the top it'd be governmental funds broken into subcategories of your general fund, special revenue fund, capital improvement funds, debt funds.
So we're only trying to think of the sidewalk debt, what would that be classified as?
A debt service fund.
Okay.
Right, are you, or was that the capital the piece where you issued debt and got the proceeds, that would sit in a capital improvement fund.
Okay.
Is that what, okay, just making sure I'm talking about the
No,
right,
I- it's
the fund
okay.
you're referring to.
We-
I can show you where that is briefly too, that's.
Okay, yeah, that was a vote that happened a couple of years ago.
Yep, so if you go to page 6-1, you'll see the second to last column. It's a capital projects fund, sidewalk construction fund.
There we go, okay.
And so what that, I believe, represents is you issued debt, correct? And now those funds are still sitting there to be spent. Okay? Page 4-7 is your governmental funds, the revenues and expenses, changes in fund balances. We did go through the totals of the, all of the governmental funds combined. And actually, I think it's important maybe that I pause and discuss why this is presented as it is. General fund is always required to be a major fund. And then based on a calculation prescribed by the GASB, you drop in the total revenues, assets, expenses, and liabilities of each fund, and it tells you what you need to report as a major fund. So this year, and this can change from year to year, this year, the major street fund was also a major fund, and that debt service fund. Then everything else becomes a non-major fund and gets audited as one opinion unit. So what that means is we're essentially auditing these columns separately as different opinion units, and we could potentially qualify over one of these but still issue unmodified opinions on everything else. If let's say one fund was just egregious and we couldn't rectify the errors. That didn't, of course, happen here, but just as an example. Page 4-8 following breaks down what the expenses were, expenditures for each of these funds, including the non-major funds in total, and leads down to fund balance, the total fund balance. Now, the following page is the income statement side of the reconciliation from your modified accrual to your full accrual. So this adds in what the changes are in those assets and liabilities at the full accrual level. It adds back items such as your depreciation expense that wouldn't be put into your governmental funds because you don't hold capital assets. And all the other pieces that go through it related to the long-term assets and long-term liabilities. Next page gets into those proprietary funds. The water and sewer fund being the largest, and then the senior citizens housing fund is considered a non-major fund. It's relatively minor. For any of these funds that we have labeled as non-major, especially in the governmental funds, you can refer back to page 6-1, which is other supplementary information, section 6 really. That breaks down what every one of those funds is, and that totals column flows forward to your front schedule. That is a schedule that you do not have to report in your financial statements. It's very uncommon to not report it, though, because people want to be able to see, okay, what are these non-major funds? What makes them up? Which's the biggest? I'm going to skip to the income statement here. Statement of revenues, expenses, and changes in fund net position. That's on 412. The first page here is relating to the operating revenues and expenses. And you can see that the water and sewer fund had about a $500,000 operating income, a small gain in the senior citizens housing fund, and then $60,000 loss overall in the internal service fund. And again, I want to point out the reason that these are enterprise funds is because they're largely driven by charges for services. So in the case of your water and sewer fund, it's customer fees. In the case of the senior citizens housing, it's rental income. You would never see those as primary revenue drivers in your general fund, for example. It's always going to be property taxes or state shared revenues, other sort of intergovernmental grants.
What you're saying,
What's that?
You're trying to tell us we're not charging enough for them two areas for water?
I didn't say that. You had an operating income there, but that's not everything that goes into it, right? On the next page, there's other items that are non-operating that you have to consider as well. In this case, there's property taxes that go into it. There's capital contributions. There were some transfers. You always have interest expense on the debt. So those items have to be considered as well. We also had prior period adjustment in here to bring on some of the legacy liabilities, and I can't remember, I think it was the pension, but I want to verify that. Might have been OPEB. It was OPEB. And that was brought on as a prior year adjustment on 4/13. You'll see the negative 1.5 million in the water and sewer fund. And if you flip back to page 411, by the end of the year, that total OPEB liability had actually been reduced, if you will, to 1.4 million. So that's where that sits now in the balance sheet, in the non-current liabilities. And that primarily represents retiree health care. It can be anything you pay to your retirees, but that's always the bulk of what your OPEB, I always say these acronyms, please, if I do and you don't know what it means, catch me. Other post-employment benefits. So what that means is anything paid to retirees except pension. Okay? Page 414 starts the statement of cash flows. This really just describes how the cash moved throughout the year, and I don't usually go into this unless there's something somebody has a question on. And then page 416 is the fiduciary funds. And on the fiduciary funds, we have the pension trust fund. That's for the fire, which has about 4.6 million in investments. Then we have custodial funds, which primarily represents the tax collection fund. New on page 417, with the implementation of that new accounting standard, is that the custodial funds have to report their additions and deductions. And so about $12 million was collected on behalf of other governments and dispersed to other governments during the year. So not just governments, authorities, anybody who has the authority to levy a tax. So for example, that would have went to the school district, as an example, some of it.
Are these an example of where the city becomes the collection agent for other entities?
Right. So when you guys send out a property tax bill and it's $3,000 and you get that bill paid, you don't get to keep that $3,000. You guys might get 700 of it or whatever it may be. And the rest gets sent out to those other districts, authorities, whatever it may be. 418 begins the footnotes to the financial statements. This is still considered a basic financial statement. Note 1 is a summary of significant accounting policies. I encourage you to read that, and unless there's something in particular you would like me to go through on this, I don't know that I'd like to touch on anything except perhaps where the capital asset policy is, since we brought that up. That would be on starting on page 420 in the bottom right. This has been the working policy in the past. Currently, assets costing $5,000 with an estimated life in excess of 2 years. And then a little further down, you'll see the range for the useful lives that assets are depreciated over. And these are very typical ranges that you'll see. 31 years for buildings and improvements kind of stands out as a little strange to me, but not something that is wrong, if you will. But that seems more like a tax depreciation life of 31 years. Usually for buildings, we see just 30 because tax and accounting rules are different. It's separate. I'd like to flip to 422 at the bottom right. We disclosed that new accounting standard, GASB 84, was implemented. It's always a best practice to disclose what changes there were in the accounting standards during the year and whether they'd been implemented. The following page goes into a little more detail on what each of the new accounting standards are that are coming up. I only went over 2 of the new standards that'll be coming up because those are the most relevant and will have the biggest impact, be the most pain for Kelly and me. But these other ones, we like to just present you with so that you have the knowledge and you have it there for you. Footnote 2 describes the information related to the budget as well as whether there are any budget overages. Onto page 425. This is note 3, and this is regarding the deposits and investments. And so what this does is breaks down what the mix of cash versus investments is, where it's held, whether it's in governmental activities or business type, the fiduciary funds, so on and so forth. And then on the following page, we describe some of the rating information, some of the risk information, and the fair values ultimately in footnote 4. A lot of the investments at the city are held in the Oakland County Investment Program, which is very common in this area, or in mutual funds. As you all know, governments outside of trusts are very limited on what you can invest in, and it almost has to be risk-free in a sense. Not exactly risk-free, but almost risk-free.
What's the lowest that could be?
Probably the treasury note. Is that what you mean? A treasury, in the federal government.
Okay.
Footnote 5 discloses the breakdown of the different categories of your capital assets, as well as how much the depreciation expense was during the year. And this is segregated for your governmental activities on page 427, the business type on 428. And it shows also on 428 how the depreciation was allocated across the functions. Note 6 is a required disclosure regarding interfund transfers or receivables and payables that still are outstanding at the end of the year. There's really not much exciting to discuss regarding that. Footnote 7 is a disclosure on the intangible asset, that big $6 million asset sitting in the water and sewer fund, and what that is made up of. And in this case, it's those 2 drains less their accumulated amortization. And those are being amortized over 40 years.
Those drains you're referring to, are those like county-wide drains that we own a piece of it, shall we say?
Correct. That's exactly what they are.
And is the amortization represent a depreciation of that drain?
Yes. Yep. So for an intangible asset, instead of saying depreciation, we say amortization. Exactly the same thing.
Is 40 years typical for that type of project?
It's not abnormal. I would say more common would be 50.
Oh, really?
I would think. Usually infrastructure type assets are pretty extensive as far as a longer term. I know it's not quite the same, but typically water and sewer mains, you see 50 years, maybe 70 years, depending. Again, it's based on policy, and all it has to be is reasonable. Just because you choose one, somebody else chooses something else, doesn't make either right or wrong, unless one's way out there. You want to go for 200 years, you're probably going to have a problem.
I think we got a couple hundred years in the city. Based on the capital improvement plan they put out. I think there were a few built in the 20s.
Was it that big?
I think we got some antiques.
That have been built that wrong, but I'm assuming those were only depreciated and expected to be around for 50 years, probably.
Exactly.
Yes.
So they're really,
Yeah.
like a really good used car.
Yeah. Footnote 8, beginning on 430. Excuse me. This is the detail of the debt that is held at the city. It not only bonds, but also notes and the related premiums, if there are claims and compensated absences. I'm not going to go into the detail here, but if you look at the ending balance column, which is the second from right, and you go down to the bottom, there's $31 million there. That represents the total of the outstanding debt of the governmental activities. Immediately to the right, you see 2.9 million. That's how much has to be paid during fiscal year 22, I'm sorry.
This year.
This year, yes, by June 30, that will be the amount paid for just principal, not including the interest. Next page is a couple of pieces related to the business type activities, much less in those. Following page is the actual maturity requirements for the first 5 years and then 5-year increments. So you can see pretty much every year for the next few years, you're going to be paying between $2 to $3 million for just the bonds at a minimum. I'm going to skip ahead to some of the pension systems on 433. So these footnotes, footnote 11, the pension footnotes are very extensive and go into a lot of what the assumptions are and the benefits. And I'm not going to go into all of that, but I just want to point out this summary schedule at the top left. There's two plans here, two defined benefit plans, I should say, the MERS plan and the fire department. And the fire department actually has a net pension asset of $714,000. And that's primarily due to a good investment year, or partially, I should say. But what that means is that it is overfunded currently by $700,000. Now, that doesn't mean that it'll always be that way. The market moves, and it could be different next year. Likewise, conversely, really, the MERS plan has a net pension liability of $1.1 million. And I will say I would almost bet that number is going to go up next year because as of your measurement date, pretty much every MERS plan there was as of the 12/30/2020 measurement date it was a good quarter end for the market. So the market has shifted down since then.
You'd mentioned the nature of the investments that these our governmental agencies are allowed to make. I looked in the $30 million out of treasury notes and things like that. You talk about the market. How much of this is invested in things like mutual funds and stocks?
So, good question, and we can, I think, look at that. So these, let me step back for a quick second, are not limited to what the city itself is limited to. When they're held in trust like this, it's opened up to a wide variety of things. You're limited by certain derivative instruments and certain real estate trusts until I think you have $250 million in assets. But you really opened a lot of stocks and other types of things. So it's opened up and can be more volatile.
Again, the city versus,
The actual plan itself.
okay.
So when something's held in trust, it's protected, right? The city council, no matter who the city council is at what time, can never go and say, we're going to take money out of the fire department's trust. It can't happen. It's legally restricted, protected from creditors. Likewise, the funds in the MERS plan.
But what their investment instruments are different than what we're required to have.
Correct.
Okay.
Correct. They have more options, more availability to try to get a better rate of return, essentially.
Okay.
Less about preservation and more about a long-term rate of return typically. I'm going to skip through some of these.
Are you still on 433?
I can be. Did you have a question?
Yeah, because I was trying to find it, and I found it actually, regarding assumption regarding inflation. These numbers don't seem in line with what we're currently experiencing.
Sure, and that is actually okay. I don't know if you're surprised to hear me say that, but remember, all of these types of assumptions are based on long-term expectations.
Okay.
So it's supposed to be what's going to happen over the lifetime of these plan members, not necessarily, otherwise these numbers would be changing like madly every single year.
Okay.
Well, not necessarily, but
And that goes through the retirement benefits, but where else would a fluctuation in inflation impact our financials?
I mean, I guess technically everywhere because think about your Act 51 funding. That's the gas and weight tax.
Mm-hmm.
So if gas prices are higher, you're going to receive more money because the taxes on them is going to be more. Your state revenue sharing is based on sales tax. So if prices of goods increase, there's more sales tax. So across the board, I would say. I can't give a lot of specifics,
No,
but
no,
hopefully
I'm
that
just-
helps.
Yeah, no, like I said, it was just something that came to mind, and I saw it there. But
Yep.
again, this
I mean-
applies to the investments more than anything
Sure.
else. I
No,
understand.
also, your property tax revenue, right? Home values go up.
Yep.
If the millage stays the same, you'll have more property tax revenue.
Okay.
Okay. Let's get through these pension notes. There's a lot in these, and I'm happy to answer questions on them, but it is a lot to wrap your head around. The OPEB note is note 12, very similar to the note we just went over. I think, as I recall, it was about 14 million. Yes, $14 million. This is actually something I did not point out in the pension, but I would like to point out here. If you go to page 439, I'll give you all just a moment. Pension and OPEB liabilities are largely driven by what is called the discount rate. And so that's how it's discounted into the future. And I want to point out, if you see in the bottom of 439, the current discount rate, your total OPEB liability is $14 million under the current discount rate of 2.18%. If that fluctuates 1% either way, you can see what the increase or decrease is. So if we were to lower the discount rate one point, we'd increase the liability by $2.4 million. So that is a significant assumption in these liabilities. Likewise, healthcare trends up in the top right of that is the other significant assumption, the most significant. And just like with the discount rate, if you lower it by 1%, you're going to go down nearly $2 million. And this is how much they expect healthcare costs to increase over the future, into the future. So just know with these pension and OPEB liabilities, they are a very, very, very massive guess, a huge estimate, because so much that goes into it is based on presumptions in the future. The only tangible part now is what you've paid out, what you've paid in, and what your assets are. Everything else is a guess. You're guessing how long people are going to live. You're guessing whether they're going to retire and be eligible for benefits. Everything's a guess. And that's done by the actuaries, thank God.
Not your job.
Yes, we audit it for reasonableness and make sure the assumptions are correct. Two last things I want to point out in the footnotes. That's page 440. Page 440 has footnote 15, which are the prior period adjustments. And in this, I have shown based on the varying opinion units. So these are the different categories that we provided an opinion on, all of which, again, were unmodified, what it was previously stated at, what the adjustment was, and what the ending fund balance or net position was. And then footnote 16, once again, GASB Statement 84 was adopted. We always like to put that in there so that everybody's well aware. And what that was part of that with the GASB 84 is the VEBA Trust Fund had traditionally been reported as a fiduciary fund, but under GASB Statement 84, that VEBA Trust Fund is no longer required to be reported that way because it is defined contribution plan rather than defined benefit. Section 5 is required supplementary information. And what you'll find here is budgetary schedules for your major funds, and then supplementary schedules for the pension plans and the OPEB plan. I don't think we need to look through the budget too much. We already talked about where there were overages, but I would like to point out a couple of things in the pension and OPEB schedules. So beginning on 5.6. 5.6 is regarding the MERS plan, and this schedule became a required schedule in 2015 when GASB Statement 68 was created, and it'll ultimately be a 10-year schedule, a rolling 10-year schedule. We're not there yet, but if you look in the 2021 column and towards the bottom, you'll see 95.59%. What that means is the plan is 95% funded, and that's very good. Right now, the state is mandating everybody should be at 60% funded for pension plans, and many are not. And when they aren't, you have to do a corrective action plan and go through a process with them. So 95% is a well-funded plan for the MERS plan.
I'm curious, looking back at 2018, we were 44.3% funded?
Yep, then
So
you
we
issued the
jumped to
pension bond.
94. Okay, how did that happen? I'm just curious.
So, yep, so I wasn't here, but this is very likely what happened. The state put out that new law saying everybody needs to be 60% funded. Whoever was on council or in finance at the time said, we can do a bond and fund it. So they did a bond, they funded it. You can see you got nearly to 100%, and that fluctuated since from the market, from contributions, and so on. But that was likely at the onset of when that 60% rule started coming out. So you could avoid that corrective action plan and the extra work there. That's what I'd like to point out really on each one of these schedules. Well, first, the next page, also a 10-year schedule. This is what was contributed versus what was required to be contributed based on the actuary's analysis. So the actuary says you had to contribute $83,000, and you did contribute $83,000. That's the main piece you'd want to look at on this schedule. And so you'll have these two schedules for each of your plans. 5.8 is the fire department, where you can see, if you look at the 2020 column, it was at 82% funded, and now on 2021, it's 118% funded. If you look in the middle, under plan fiduciary net position, you'll see a line called pension plan net investment income, and you can see there was $1 million gain this year because of the investments. And knowing that the investments ended at 4.6, that's a pretty hefty gain.
When you say the middle,
Yep.
are you referring to, under plan fiduciary net position, is it the pension plan net investment income?
Correct. You got it.
Okay.
$1 million there during 2021. So very good gain because of favorable market conditions.
Boy, I'd love to know there were 151,000 the year before, and $1 million.
So
of that.
again, it's based on the assumed rate of return, and some of that gets amortized over future periods as well. I don't know how much you want me to go into that.
No,
Okay.
you don't have to. I just find it interesting that whatever investments they had such a significant increase in just 1 year.
That was a good year, though.
Yeah, that, I think it really was
but
market
Still,
driven.
you have to be invested in just the right stuff. I mean,
Yeah,
I've got a
but-
portfolio, I keep track of it.
There were some that really took off.
Yeah, somebody
So-
must have wagered a fair amount of the cash on those. I mean, wager is perhaps a strong term, but
There was some.
wisely invested.
There were some really outperforming mutual funds that probably had a lot to do with it, over 120%.
Not higher than that.
It was crazy for that period.
Whoever the fund investor was, I'd like to hire him.
The next page again is the schedule of actual contributions. The actuarially determined contribution was met, and that's what you're looking for there. 510 is different than the MERS schedule because this is a single employer plan. And so you're required to show scheduled investment returns. So here you see in 2021, we have 28% investment returns.
I'm sorry, what page are you on?
510. It just discloses what the investment return was for the year. Next, on 511, you'll see there's nothing set aside related to the single employer OPEB plan. So 0% funded. The state does require 40% funding. Well, I shouldn't say require. They wishes everybody would have 40% funding. And with that, there is a calculation that you do in a form that I'm sure Kelly submits 5072, I believe it's called, annually. And based on the calculation, they determine whether they consider you underfunded or not. So it's not purely based on your funding percentage. It's also based on a ratio of your actuarially determined calculation or contribution and your governmental revenues. I don't know that off the top of my head, but I know that's the basis.
So, I'm sorry, if you go back one of your original statements about the percentage of our expenditures and how our percentage going to debt service was relatively high.
Yep.
For community. Is that reflected in the fact that our pension fund?
Oh, it's got to be. I mean, we
So-
can look real quick into the debt note and see.
That's what it was.
Yep.
Okay.
We can easily see where the, oh,
You don't have to get into the detail, I just wanted, kind of a rough
Sure.
generalization is, okay, we're looking pretty bad in one area, but we're looking very good in another. The two are kind of counteracting each other, I'm assuming.
yes, I'm sure of that. I can't tell exactly which one in here is the pension bond
2018.
2018. So that made up $600,000 of just for principal, $615,000. I'm sure the interest was probably $100,000, $200,000 as well.
Okay.
Okay. Nothing else to see in section 5. And then section 6, we briefly touched on from one of Glenn's questions. This is just the makeup of those non-major governmental funds. It details it out a little more. It's other supplementary information, and it's not required to be reported, but it's very commonly reported. I don't really have much to talk on regarding that, unless there's any questions on it. Otherwise, I'll just take questions.
Councilmember Shepherd, do you have any questions?
No, you answered my questions as we went along.
Yeah,
Good.
same here.
No? How about you, Councilmember Sampson? You're good?
Yep.
So all the questions that you submitted to him previously have been addressed for you, so you're content with this?
Well, I already got the answers from him.
Pardon me?
He already sent me answers on them all.
Okay, good. Do you have anything else for us?
I don't. That's all I have. Thank you very much. I appreciate it. Appreciate you guys listening to me. Hopefully, I answered everything to your satisfactory. I'm happy to go through.
How was your experience in working with us?
It was a good experience, a challenging experience, but I think you guys are in good shape going forward. I think you've got a good setup. I'm looking forward to working with you. And Kelly did a really nice job. I do want to thank Kelly. Thank you.
Kelly, do you have anything you'd like to share with us, having gone through this
I
process?
just wanted to thank Mike for being gentle, because it was a more difficult audit than I've experienced in the past, so.
Were there any trends or anything that you saw in this little picture of what you looked at that that will change what our approach is going forward? Curious.
No, I don't think so. I mean, I've got the list of what I expect will be audited next year, and everything will be up to date by the time we get to the end of the year, and, hopefully, we'll get these budget amendments passed as they come through council. Less turnover is helping, of course, so that always puts a little damper on things, so I think everybody's kind of starting to run a little smoother.
Yeah, I'll say, this is also fairly, when there's turnover and the documentation hasn't been laid out in a nice manner, or if there's not a nice training transition process, I see this from time to time. And this isn't the only audit that I've had this year, considering the way employment has been everywhere, where somebody at a very high financial level that's responsible for many audit schedules or maybe the entirety of the audit has left that position, and there's been gaps. And so in this case, we had that situation where some of the work papers we were unable to find without recreating, and then on top of not being able to observe any of the prior year auditors' work, a lot of times some of this stuff is built up year over year and it's carried, and so that created a challenge.
So you had So the couple challenges were the previous auditor and the lack of information, right? And then the other is, I guess, do we need to, my opinion is we need to have a more robust procedure, making sure that what we've uncovered here, what you've uncovered here is more laid out in a appropriate and auditable way and reproducible.
Right.
Right? You know.
Well, I think it will be now that, we've worked through it and Kelly has identified, okay, here is this schedule, and we've, in some cases, recreated them or improved them, whatever you may call it. They're there now. There's a starting point now, if you will. And that's the key piece of it.
Yeah, they are all now housed in one section of our shared drive, so electronically, anybody that has access to that drive can access the folder.
Okay, and that's set up as a policy that we're now going to be following.
It's my policy, it's not a written policy.
Yeah, I know, that's kind of where I'm going,
Yeah.
right? So it just,
It's really standard policy, that
Sure.
you should have information available at the tip of your fingers, whether it's in a cabinet or on a file folder on the computer.
if there's a way of codifying it to make sure, not necessarily in ordinances, but at least this is
I'll
how
let
your
you
work
write that
instruction. Well, no, I guess my point is that, like, I've gone through audits in my professional career, right? So in having like two for whatever they are that sit down and say, okay, what now? And then what now? And what do you do next, right? And so if you don't have that in place, you're in trouble of losing your accreditation, right? So, and that's where, at least for me, and that doesn't necessarily apply for what you're doing, but at least you're looking to see that, okay, how did you get to this point and where we're starting from, is it clean, right?
Right.
Then it comes back to, okay, what were we doing before? Now, you uncovered a little bit of that, right? But now we need to make sure.
We have updated quite a few things
Okay.
since a year ago, so there are different procedures that are put in place already to prevent having to recreate or try to find different information for the auditors.
Okay, and those things change, right? And like you're saying, the Gatsby stuff is gonna make some of those things that you have in place obsolete. Let's update them. What's the procedure to update them? Are we following what we need to do in order to apply for whatever the Gatsby changes are? So, all right, I guess those are the types of things. QS is being tossed around pretty often now. And that's the type of thing that I'd like to see. Obviously, your organization may be involved in something, not necessarily for government, but someplace else in another branch of Yo for ISO and QS and things like that, right?
So, yeah, we're big on a lot of, so we have a whole cybersecurity, computer consulting.
Mm-hmm.
So that side of technology controls, a lot of controls that we go over with the auditing side of things and best practices. And
And you
type of
touched
thing.
on that in the
Yeah.
report.
Right,
Okay.
correct. Yeah.
So you never got any of the information from the previous auditors, right?
No, I didn't.
We need to put that on our, one of our agendas and discuss that with the attorney, because we had started talking about some kind of legal proceedings, because we ended up paying you more money to rebuild all that. Do we need to recoup that back from them?
That is not a call I will make.
The city attorney
No,
might
we just
answer
put it on the
that.
agenda so we
Let
can
the city
discuss it.
manager know.
Yeah, well,
There you go.
All right.
collectible is that, may be the question.
And what's the real point? Like, if it's a few $1,000s, is it worth dragging someone through the mud? I say no. But we'll discuss it at another time.
We can do that.
So if there is nothing else, I would like to call for adjournment, which I'll do myself. I make a motion that we, first of all, thank Mike for coming here
Thank
this
you.
evening. Thank Kelly for doing this process. We really appreciate your work, and we look forward to moving forward in a cleaner, more concise process. Thank you so much to Scott and everyone else who helped you along the way. I'm not sure who all the parties were, but
Everybody.
yeah, thank you, everybody. Thank you, one and all. So with that, I made a motion to adjourn. Would someone please support it?
Support.
Thank you.
We don't need anything.
Attendance will start, so. We're
We're done.
Just say aye, so yeah.
Can't adjourn something you didn't.
I don't think you can just get up and leave.